So I totally get it. Learning the tax sale process can be confusing. And often the more layers you start peeling back, the more confusing it gets. Today I'm going to talk tax sale to you in layman's terms. We're dumbing down the 3 most confusing things that new investors struggle with. Now, before we get started, my name is Casey Dimon. I've been investing in tax liens and tax deeds for well over 2 decades now. And I've been training others for more than a dozen years through my videos, books, and comprehensive training academy at taxsaleacademy.com. I want to decipher some of the Greek that is tax sale investing. Many new investors get involved in this business because it looks like a great opportunity to make some cash. And truthfully, it is once you understand what you're doing. But what you often see is new investors exit this business before they even get started simply because they think there's some sort of special lingo or certain things that just confuse them. The truth is, once you understand the basics behind this business, and once you understand how to operate properly, it's actually pretty easy. Unfortunately, we can't discuss every single thing about this business in this episode. So I've decided to discuss 3 of the most common things that confuse new tax sale investors. And hopefully it helps you out on your quest for tax sale success. Now, inside the Tax Sale Academy, of course, we go through hours and hours and hours of training to make sure that nothing is overlooked. But hopefully these 3 will help you get started. The first one is the different types of tax foreclosure systems. Now, there are 3 primary delinquent tax systems that are going to be used. We have tax liens, tax deeds, and redeemable deeds, also called redemption deeds. Which one of the 3 that the state uses depends on how their laws are written. Now, different states have different systems. So what happens in Arizona, for example, where they sell tax liens is different from what happens in Michigan, where they sell tax deeds. They have a different set of laws in each state, and they must abide by those laws. And even states that have the same basic system might have different laws within that system. So for example, even though you have 2 tax lien states, they might have different timelines they have to follow. One might say you have to hold the tax lien for 2 years, where another one says you might have to hold it for 3 years. So understand, and we're going to get into more detail about what all this means, but understand that every state is different based on their state statutes. There's no overarching rules or guidelines or laws that every state follows. Every state has their own state statutes that they must follow. So even though I'm about to discuss each one of the systems, you need to take the time to dive into the specifics of each state that you're thinking about investing, and that we have a complete understanding of it. Now, understand right off the bat, everything starts the same way, and that is when the property owner fails to pay their property taxes on time. Obviously, the county needs that money. They rely on that money to cover roads, schools, police, fire, and all of the amenities that those taxes pay for. So, with a tax lien system, they will sell a tax lien against the property. And basically, what this means is you are paying the past due taxes for that property owner in exchange for a return on your investment, which we'll discuss, which is backed by the real estate that had the late taxes. So, for example, let's say they have a $1,000 tax bill and they do not pay that tax bill. So you would go in there and you would pay that $1,000 tax bill essentially for that person, right? That $1,000 is going to pay those property taxes that the county relies on for all the services we just discussed. In exchange for that $1,000 payment, you get what is called a lien on that property. So just like a mortgage company gets a lien against a property when they finance it, when you buy a tax lien, you too will get a lien for that property or against that property. Now, what happens is you pay that $1,000, you have this lien. The law will allow them a set period of time to come in and say, listen, I understand I was late, but I came up with the funds, or I just remembered, or whatever the situation is, and I want to pay you back. I want to keep my property. So they will repay you. They'll give you that $1,000 back, plus a healthy interest rate that will beat most markets when you invest correctly. In exchange, when they do that, you'll get your money back plus interest, and the lien that you own will become canceled. Okay? You get your money back, interest, and the lien is bye-bye. You move on to the next property. Now, if they do not pay you, if they forget about it, if they're deceased, if they can't come up with the money, if they don't want the property, all those things, whatever the situation is, if they don't repay you in that set period of time as set by your state statute, you are allowed to foreclose your lien. What this means is you will be able to take ownership of the property. And that is essentially the ultimate home run when it comes to tax lien investing. The next tax sale product type is called a tax deed. So with a tax deed, the property taxes go delinquent. Every system starts the same way. But instead of the county selling a lien against that property, the county will basically hold that lien themselves. They will usually then require the delinquent taxpayer to come directly to them and pay off the back due taxes plus some sort of penalty and fee. That's where the county will just hold all this. They'll put it basically on a late list and they'll wait for the property owner to come in. Now, usually it will sit on that list and some interest and stuff will accumulate, which is, the county's money, the county's interest that they get on the property. And it'll sit on that list for maybe 2-3 years. And then after waiting for this set period of time, the county will foreclose themselves on that property. And what happens then is once they foreclose, they will take that property and they will sell that property at a public auction. So in this situation, you are not buying a lien. You have no ability to buy a tax lien against the property. You're actually buying the actual property. You will become the owner of the property in a tax deed state. Your entire investment hinges on the property itself. And once you buy that property, outside of some very, very rare circumstances, you're not going to get paid back or anything like that. You have to sell that property in order to make your money. So that means to eliminate as much risk as possible, you need to learn as much as possible about that property, the market it is in, the value it's in. You better have a plan that will allow you to capitalize on your investment to realize your return. Because just buying the property does not make you a dime. You actually have to put forth the effort and potentially deal with any issues or cleanup or just sell the property as is to realize your investment. So far, we have tax liens, which is a lien against the property, and tax deeds, which is the actual property itself. Last is somewhat of a twist between the two, and it's called a redeemable deed. So redeemable deed or redemption deeds are only available in a few states, but they can be extremely profitable, so they are worth discussing. Now, a redeemable deed situation starts the same way as every other state, and that is when the owner of the property fails to pay the taxes on time. Now, instead of selling a lien against the property or waiting 2 to 3 years to sell a deed against the property, the county will kind of split the difference. They'll hold that property on a late list for maybe a year, maybe 2 years, depending on the state statute. And then they will take that property to a redeemable tax deed sale. And again, this is more or less a cross between a lien and a deed. So you will actually buy that property at that redeemable tax deed sale. You will become the owner of that property. But hold on here. There's going to be one last redemption window in which the late taxpayer, the delinquent taxpayer, can say, listen, you know what? I know my property's already sold, but I finally came up with the money that is due. And I will pay you back plus interest in order for you to cancel that redeemable tax deed. I want to redeem that property from your tax deed, which means you will lose ownership of the property, and that property will go back to the ownership of the person who was previously delinquent on their taxes. So, for example, in Texas, let's say you buy the property is going to be yours. Now, if somebody comes back within a 6-month period and says, I want to redeem this property, you will get your money back plus 25%. So your return here is going to be higher than most tax liens, but you're not going to own the property any longer. Once you do that, you will likely quit claim deed the property back to them or go through the different process to get the property back to them, depending on the state. And you will lose interest in that property, but you'll have a nice little return. Now, of course, if they do not redeem that property, if you buy it at a redeemable tax deed auction and that extra window of time comes and goes and nobody redeems that property, then the ability to redeem the property simply expires and the property is yours to do as you please. So those are the 3 different types of tax foreclosure systems. Hopefully that helped to clarify it some. And of course, I've got a lot of episodes and a lot of videos on YouTube about each one of those systems. Now, the next topic that is very confusing for many new investors is the title cloud and title insurance issue. And I can certainly understand how this can be confusing because it confused me when I got into the business. So when you purchase something on the open market, like through a realtor, for example, you'll have a fancy closing with cookies and a whole bunch of documents that you're likely going to sign. Part of those documents will include what is called a title insurance policy. They will give it to you for you to review. You probably won't even take a look at it, if we're being honest. You likely have never noticed it, and you probably just shoved it in the folder or put it in your desk somewhere. Didn't pay much attention to it. Now, in that title insurance policy, what they will have done prior to that closing is they will have researched the title to that property. This means they go through all of the official records that pertain to that property. They look at outstanding liens, mortgages, and other money that is owed on the property. They also look to make sure the property has been properly transferred from one person to the next. So for example, if 2 people own a property, they want to make sure that both of those people have signed the documents to sell that property to the person that you might be buying it from. Otherwise, you still have one outstanding owner out there and you probably don't want that. If anything is wrong, they're going to work with you to fix it, or they'll simply refuse to issue what is called the title insurance policy. This title insurance policy protects both the buyer and the seller, since any claims against the title of that property would be handled by the title insurance policy. Now, an example might be you buy a property, you go through the whole process, they say there's no liens against the property, and then 2 or 3 years later, a bank comes out of nowhere, says, listen, there's a mortgage on this property, it's recorded in county records, you owe us $500,000 if you want to keep the property. And you're like, whoa, I didn't know anything about that mortgage. That is an example of when you would go back to the title insurance company and they would take care of it for you. Now, I say all that to set this up. When you buy a property through a tax sale, a title insurance company sees this as being risky, and they will not insure the property without additional action. This means you cannot sell the property the same way you sell most real estate. You cannot sell it with title insurance, which means the value of the property is going to be diminished. And you can kind of compare it to a wrecked vehicle, right? The value is going to drop substantially until you repair that vehicle. Now, you can sell the property as is to another investor. And when I say as is here, I'm not talking about the physical condition of the property. I'm not talking about broken windows and stuff like that. I'm talking about the condition of the chain of title, which doesn't allow you to get title insurance. When you do sell a property with an as-is title, understand, you're going to be selling it at a highly reduced price, but that can still make sense in some scenarios. Your other option is basically to repair that title, which would allow you to then get title insurance and subsequently full market value for the property. And there are 2 popular ways to repair that title. The first is called a suit to quiet title. This is an actual lawsuit. You file a suit against anyone that might have some sort of claim against the property. And basically what this is doing, this is telling the entire world, hey, if you think you have a claim against this property, I want you to come to court and tell me right now. Come to court and argue your case. So anybody that could have a potential claim against the property will be served a notice of this suit to quiet title. Most of the time, just about all the time, they never respond. You go to that court and the judge signs off with a judgment for you. When the title company sees this, they say, okay, we got a court order that the title is clear now, and we will issue title insurance for you. Another option to repair that chain of title is called a tax foreclosure certification. And this is where a specialized company goes through the tax foreclosure file from before you purchase the property. And they go through with a fine-tooth comb to make sure that all the T's were crossed and all the I's were dotted during the tax foreclosure process. Now, that doesn't actually repair the title or anything like that, but it does ensure to their partner title insurance company that everything was done correctly and they have nothing to worry about, at which case they will then issue title insurance for the property. So that's title insurance and title clouds for tax defaulted real estate. The last confusing thing I want to discuss are the outstanding liens. So when you buy a property at a tax sale, the large majority of states have laws that allow for tax liens to take seniority over other liens. And what this means is that the law sees your tax bill as being more important than the mortgage company debts, or the handyman's debt, or anybody else that has a lien recorded against that property. The county, the state, has put it in their state statute that the county gets paid first. They get their real property taxes. And if you think about it, it probably should be that way, right? Otherwise, everybody would just stop paying their taxes. So when a property goes through tax foreclosure, it extinguishes all of the other liens below it. All of the junior liens, including things like mortgages and second mortgages. If there was a mortgage on the property when you purchased it prior to that tax foreclosure, it is no longer attached to the property after the tax sale. Now, of course, there are exceptions to every rule, which does confuse a lot of new investors. The primary exceptions are going to be the governmental liens. While tax liens cancel private party liens like mortgages, they do not cancel governmental liens such as code enforcement liens. So I generally tell new investors that if there is a lien on the property by any branch of the government, then they should have the expectation to pay that lien. So private party liens go, governmental liens stay. And there are exceptions to every rule. For example, IRS liens will fall off after 120 days, but this should hopefully clarify it for you, at least give you somewhere to start when you're researching the title to these properties. Now listen, I've got much more detailed episodes on each one of these topics, and we teach about this in depth inside the Tax Sale Academy, but I wanted to record this episode to discuss these three topics since they're always so confusing to new investors, and I completely get it because these are things that confused me as well. Listen, that's all I've got for today. I truly hope this episode has helped you out. If this episode or any of the episodes here on the Tax Sale Podcast have helped you out, please do me a huge favor. Please leave positive feedback on whatever podcasting or video platform you're watching or listening on right now. These are free episodes, of course. We don't charge a membership or listening fee or anything like that, but your positive feedback truly helps us out in the podcasting world and might even serve to pay it forward simply because somebody checks us out and gets started in this business because you took the time to leave a positive message, leave a 5-star review, or click that thumbs up button. Now, as always, if we can be of any additional help, make sure you check out all the links in today's show notes, including the one to our step-by-step training academy at taxsaleacademy.com. Hey, take care, folks, and make it a successful day. We'll see you next time right here on the Tax Sale Podcast. Bye-bye.